If you missed the masterclass that I did on marking levels, this is the recording for that masterclass that we held in Discord. I highly encourage you to take out a piece of paper, pen, take some notes. We went over some very key things in this mastermind class. We're going to do plenty more of these held in Discord. So if you're not in Discord, there's a link down in the description for you guys to join up. It's a good time. A bunch of traders talking trading, no BS, no fluff, just traders trying to get better at trading every single day. Also, I am live right here on the YouTube channel at the New York Open, Monday through Friday, 8:30 a.m. Central time, day trading the NASDAQ. You see my green days, my red days, my full tilt moments, everything that involves me as a trader, you see live right here on YouTube. So smash that subscribe button, fam. With that said, let's get in the video. We're going to go over marking levels. Guys, it sounds so simple, right? Marking levels, it sounds very, very simple, right? But a lot of people still do struggle with this sort of thing. And so the goal of this presentation is to really kind of hopefully simplify it. And, you know, you guys be able to come into the charts and understand what key levels are in the markets that the market's likely to navigate to, right? And so that's the overall goal of this presentation. So we are going to talk about how marking levels will change your trading. And trust me, it will change it for the better. Why is it important to understand key liquidity levels and how to trade them? The reason behind this is that you basically become an independent trader, right? You no longer need to you don't have to rely on indicators. You don't have to rely on copying someone else, and you don't have to feel like you're completely lost on where price is likely to go. There's a lot of traders, a lot of people that I encounter that they do rely on other people for trading, or they do rely on indicators that are trying to tell them, you know, where price is going to go, where price is likely to go. And the problem with that is most indicators are lagging, right? By the time that the indicator has already told you what to do, it's probably too late, right? A lot of the indicators are lagging, they're late, and the price has already done what it's going to do by the time that the indicators have told you, right? Now, there are some indicators that are a little bit different, things like VWAP, right? Where they're a little bit stronger, but that's the big issue and the big controversy around indicators is that they are lagging. By the time that the indicator has already indicated, done its thing, price has likely already been to where it's already done its thing as well, right? The price has already gone to the level it's going to go before the indicator has told you that, right? And again, as I said, there are indicators that are a little bit different, like VWAP, they aren't as lagging, but most, if not majority, right, of indicators are lagging, and that's the big problem. Now, going into where you're copying other people's trades and getting trade ideas from other people, the problem with that is you don't really understand why you are winning or why you are losing, right? You see somebody hop into a trade and they take a 20-point, 30-point trade, but do you really know why they won? Or if they lose that trade, do you really know why they lost, right? And so that's the big issue with copying other people. And so again, the big idea of this presentation and this masterclass is for you to gain total independence of your trade and take total control of it, right? Where you can come into the charts, you can mark out key levels, and you can have that total confidence in those levels for you to then take those trades, right? And so that's the overall goal. Does all that sound good? Can I get some? Let me know down in the comments how we feel. Does that sound good? Yes, you can ask a question at any time. Anytime during this presentation, you can ask questions. So feel free to fire away. I'm here for you guys, right? Again, this is just to help you guys become independent traders and to be able to come to the charts and mark key levels on your own and understand the trades you're taking and understand why you were losing and why you're winning. Right? It's all revolves around price action. You don't have anybody telling you what to do. You don't have any indicator telling you what to do. You are telling yourself what to do by marking out key levels, and that's the goal of this. Just a quick show of proof on this works. These are some of my students from the mentorship that are going through it and have marked key levels. You know, Sam here, he didn't have any idea on the trades he was taking, why he was winning, why he was losing. And he came into the program and he learned how to mark key levels and was able to take payouts, right? Same for Krista, took her first payout ever, right? And all of this revolves around understanding key levels, marking them, and being able to take trades from them with total confidence in your decision making and in your actions, right? That's the whole goal of this. All right, so what are these key liquidity levels and how do you spot them? For me, what I do is I look on higher time frames. I look on 15 minutes, I look on 30 minutes, and I look for areas where there are multiple touches in price, right? What price level have we come down and touched multiple times and unable to continue to push through, right? That's what I'm looking for, because those are showing me key liquidity levels where a lot of traders are placing a lot of orders, okay? And it's taking price in the opposite direction. Take this example here, right? We're on a 15-minute time frame, right? You see the line where we have multiple touches in this general vicinity, right? It doesn't have to be perfect, it doesn't have to be exact point or exact line, right? We know that in this vicinity here, we have multiple touches and price has been unable to really push through and push us down. And what happens, right? Well, we know that this was a key level, right? Because we have multiple touches just in this general area alone, right? We come down and retest, we bounce out of it. Now we come down and we actually sweep, and we're going to talk about sweeps here in just a little bit, right? We actually sweep the liquidity to the low side and reverse out of it. If you guys trade the NASDAQ, right, you know the NASDAQ is a very temperamental ex-girlfriend, right? It's very indecisive. It will run liquidity and it will sweep key levels, but then be like, oh, psych, nope, we're going to reverse out of it and we're going to go the opposite direction, right? The NASDAQ is notorious for doing that, right? It's that crazy ex-girlfriend. It will seek areas of liquidity, right? Chances are maybe either run it and reverse out of it, or we run it and we continue to have that selling pressure to get continuation to the downside or upside, whichever side of liquidity that we're running, right? And so in this particular example, the NASDAQ took out liquidity lows and reversed out of it and took us in the opposite direction. This is a very common move of the NASDAQ and something that I pay attention to very closely because these types of trades offer very large risk to reward, right? Very large risk to reward because generally when you get a reversal out of a liquidity area, the point value is going to be pretty large because at that point in time, it's going to try to go find the opposing areas of liquidity, right? To the opposite end, to the upside, right? We sweep lows, we're going to go find liquidity now to the upside, okay? And so that's why there's such a big point value to be taken here and such a nice risk to reward if you take a good entry because, again, the point value is pretty large. Now, there are different types of liquidity areas that I pay attention to, right? Not just intraday, not just the New York Open or the New York session. There are areas that I have personally noticed. They're just going back in time and looking that the market is respecting pretty heavily or navigating to, right? And that's the Asia market and the London market, right? And I'm going to go over a chart study here in just a second to show you what I'm talking about. And there's you can go into indicators and there's an indicator called sessions, right? Where it marks out the London session, the Asia session, and the New York Open, right? And so it just makes it easier for you to find these levels. But something that I've noticed is that the London lows or highs or the Asia lows or highs have been playing a pretty dramatic role in the New York Open, right? Whether we come down and we sweep London lows or we go up and sweep London highs, or same for Asia market, we come down to Asia lows and we sweep them and reverse out of them and go up to maybe some highs, right? We just recently experienced this this past week where we saw a very distinct Asia market low, and the New York Open came down and swept that Asia low, reversed out of it, and took us back to the upside, right? So we recently kind of experienced this, so we're gonna cover that here right now. So this is what I'm talking about. So I have this color coded. You can get this in TradingView. It's literally called sessions, right? You go into indicators, look up indicators. It's called sessions. It's not mine. It's someone else's. But it will color code basically the market, right? And this pretty much from here, this orange over, this is the New York Open. But the green time frame from 3 here marks out London, and then we have the blue here, which is Asia, right? So these are the Asia markets, the London markets, and then anything over here is the New York, right? So let's just dissect this for a second, right? On Asia's session, we have Asia's high,
up here, okay? Here we have Asia's low. Up here we have London's high. And over here we have London's low, right? So this is where we just experienced this when I talked about running Asia's low. Look at what price did, okay? At the New York Open, price came down and swept not only London's low, but came down and swept Asia's low before completely reversing out of it, right? Areas of liquidity. The market is going to, the overall job of the market, and I'm going to tie this all together, right? Hopefully you guys are sticking with me on this. I'm going to tie this all together. The overall job of the market is to seek areas of business. Where can it conduct the most transactions, right? Where can it conduct the most business? That's what the market's job is. That's what it does. It finds areas where there are a lot of orders, a lot of business to be transacted, and it navigates to those areas. The market is seeking areas to conduct business. So when you come into, just say you're not paying attention to Asia's market or London's market, you come into, just before the New York Open, you're marking levels, right? Well, you know that Asia's low or high or London's low and high are going to be key levels that the market is likely to go test because, again, those are areas of liquidity, right? And so we look for areas where we can identify these lows and highs and for price to come back down and retest. And so the beauty of this is that once you have these levels, you don't have to do anything. You can mark these levels and you can sit back in your chair and you can just chill and wait. Wait for price to come down to these levels. Wait for price to come test these key liquidity levels and see how it reacts. And that reaction is going to tell you what position you want to take or what side of the trade you want to take. In this example, we come down and sweep the lows, right? We sweep those Asia, London lows. Price gets a reaction, comes back up into those areas and takes us back to the upside, right? That was a bullish reaction of that. Okay, so that's what I mean by letting price tell you what it's going to do. You don't got to do anything. Price is going to tell you exactly what it wants to do. All you have to do is just sit and wait for those specific areas to go down and get tested. Again, just to reemphasize this, these levels provide key liquidity areas where the market is likely to go seek price. That is the job of the market, right? To seek areas where it is likely to conduct the most business. All right, so we're going to jump into some chart studies here, right? This is going to be, we're going to work through some different charts and go through these. On this chart, you can see we have a clear area where there's multiple touches to the upside. We have a clear resistance, right? Clear resistance. Up here, we saw a little bit of resistance and we sold off. Up here, same thing. We came up and tested this level, right? And what we do? Bang, sold right back off. Again, a third time where we came up and tested these levels, right? Now, granted, are you going to take a trade here? Maybe not, right? But when you see this acting as resistance multiple times, on that third time, you may be like, okay, you know what? We've been up in this level. This is where we've caught a lot of rejection. This is where price has really, really struggled to push out of. And you might take the short on this, right? You might take the short on this type of trade. This time frame is on a 15-minute. Yeah, this is a 15-minute chart. But whether it be 15-minute, 30-minute, intraday, right? All the concepts still apply, right? No matter what time frame. No matter what time frame it is, you can go from a larger time frame down to an intraday time frame. All the concepts still remain the same, right? Now, again, how 3 touches to the upside, right? But here's where the interesting part is. This is previous day's low. Okay, so this is just say previous day's low. This is was Tuesday. This is all Wednesday, right? I know it doesn't show on the bottom here, but the screenshot got cut off. But this was a Tuesday. This was a Wednesday. We have a previous day's low. Okay, price rejected up here and came down and tested this general vicinity and caught a reaction back to the upside. But where things got interesting was that price finally came down and really tested this previous day's low. And what happened? What happened during this previous test, or this test of this previous day low? We consolidated until we finally got real selling pressure, real engulfing candles breaking us down to the downside, right? And that's where things got weak. But price came down to seek this area, this previous day low, because it holds significant weight in the market. It is a previous day low where we couldn't go any lower. We saw some bullish momentum carry us out of it, right? We tried to come down and retest it, come down and run it. But again, we still have bullish momentum until finally things break, right? And that's the thing with key liquidity areas is eventually they will break. Whether they break to the upside or they break to the downside, you are eventually going to get a move in one single direction, depending on where liquidity levels are sitting, right? And so here in this particular example, right, again, I'm very big on price, on like letting price react and telling me what it's going to do. Does that sometimes cost me in good entry points? Yes, sometimes it does. However, my win rate is much larger because I'm letting price react and tell me what it wants to do. And so I get that little bit larger of a win rate, right? And also risk to reward because I am capturing a little bit larger of a move. So when price is reacting and I see a little bit of consolidation until we finally get that selling engulfing candles, right? Showing us extreme weakness, then I can make my decision, okay, this is looking to be going to the back down the downside. We are probably going to run this. We're getting some selling engulfing candles. We're getting pretty weak, right? But again, take all of that out. Hopefully, guys, hopefully I'm not losing you guys here. Take all of this out, right? The goal is to understand that price is likely to come down and test this, right? So whether you're trying to decide to take a trade or not, when we're up here, we're understanding that when we're rejecting this, where's the next area of liquidity and where are we likely to go if we do reject this, okay? And that would be right back down to previous day's low because that's where the heaviest liquidity is sitting. But again, the whole point to understand here is where are we likely to go next, right? That's the key take here, right? The key take is we know where we have strong resistance. What's the next area of liquidity that we're likely to go to? Perfect. All right. So here's where things get even more interesting, okay? And why I brought up London. So this is on a larger time frame. This is on a 30-minute time frame. So we're seeing multiple sessions here. Like this was one day, this is another day, this is another day, this is another day. There's multiple sessions here, but I really wanted to show an example on a much larger time frame and show why these levels are so key because again, they hold significant weight. The London lows, the London highs, Asia's market, they all hold weight, right? And where price has been and unable to continue and reverse out of, right? And so again, looking at this previous session's London low, right? So this is in the green area. This is London's time frame. This is London's low, okay? We caught significant bullish movement out of it, but the moment we start to catch weakness and we sweep certain areas of liquidity, look where we went right back to. Isn't that interesting? How London's low, no matter if it was the previous day or the day before, how it still can hold significant weight, right? It still holds significant weight. So when you look on larger time frames and you see distinct lows like this, chances are that the moment we catch weakness after bullish momentum that carried us up, we might actually come back down to those areas, especially if things get pretty heavy. And so these are all areas when I'm coming to the charts each trading day, I am going to be looking and marking out these levels because there's a good chance that we come back down and retest them, right? And so that's exactly what you see here. We got a sweep of the London low, right? We got a sweep of the London low and reversed right out of it. Okay, going back over to here, we got a retest of the general vicinity. It wasn't a perfect retest. We still had quite a bit of movement here to go, but general area swept right back out of it. Okay, so we know that this vicinity here is holding a lot of significant weight. So when we come to the next days, say, whether it be the next trading session or if it's a weekend, maybe coming into next week, right? We know that we have to watch out for this area because we know that price has been unable to push through and continue downwards, and we may actually catch a buy up once we come up or come down and retest these levels. Same thing here. This is why I said this is where it seems like things get really easy because it's honestly it's a really simple concept to understand when you're looking on higher time frames and can identify areas where the market's likely to go and seek areas of liquidity, right? What do you guys see here? Previous highs. Okay. So we know that, and again, we are looking hindsight here, but we're using this data to make decisions on the next and coming days, right? So we are looking hindsight, but when you come to the charts, you're looking hindsight. You're looking at, where has the market been? Where is it likely to go, right? Something I always preach, and honestly, I live by this when it comes to trading, as I ask myself 3 questions. And hopefully, if you guys have a piece of paper and a pen nearby, I would highly encourage you guys to write this down, because this is going to be huge, right? When you come to the market, ask yourself 3 questions. Where has the market been? Where is it trying to go? And how good of a job is it doing? All right. Ask yourself those 3 questions. You answer those 3 questions, you're going to find yourself with a whole lot of clarity coming into the market, right? Versus just coming and looking at the chart saying, oh, it looks like the market's going to go up, or it looks like the market's going to go down, or it looks like it's kind of moving in this general area, consolidating, maybe going up to here, right? Take out the guessing. While we are anticipating and speculating what prices are going to do, you want to limit the amount of guessing that you're doing, okay? Trading isn't easy. It's not easy. Trading will never be easy, but you can always make things easier on yourself by giving yourself clarity and having key levels in mind, right? So again, I'm going to repeat that so you guys can write it down. Yep. Okay. Yeah, I got it. So 1, where has the market been? Ask yourself these 3 questions. Where has the market been? Where is it trying to go? And how good of a job is it doing? Right? Those 3 questions will bring total clarity to you guys. I ask myself those 3 questions literally every single day. Every day. Okay, now looking at this chart here, we have previous highs. We know that we're rejecting up here. All right, cool. We're gonna mark this level. Again, we're coming into the next trading day, right? So we're just marking out these levels in hindsight. Let's mark out these levels here. We know that we have clear resistance up here, clear rejection. Now let's mark these lows here. Okay, so we know that we had a previous low down here, right? And then we came down and actually retested this low and reversed straight out of it. Okay, so that's interesting. So we know that there's a lot of liquidity sitting here. We know that a lot of people are placing trades, placing orders down here. So we're going to keep this area in mind, where if price eventually comes back down to it, whether it's today, whether it's tomorrow, whether it's next week, we know that there are levels here that the market has a lot of interest in, and a lot of business and contracts have been conducted in this area. All right, so we're gonna mark that out. Cool, and we got previous highs up here. Now, I saw a question, what if those areas are broken? How do you enter continuation? A better way for a retest of those areas. So yes, I am a big retest guy, whether I get the retest or I don't. If I don't get a retest, then I miss the move, and I'm okay with that, right? The market's the beautiful thing about the market is there's always going to be another opportunity. Is if you missed a move, there will be another one. So you don't have to chase it, right? But yes, so if I do get continuation, so just let's say, for example, actually here, you can see in the corner of the chart that we did get a breakout, and looks like probably continuation. I don't have it on the screenshot here, but just as an example, let's say we broke this area right here, okay? Let's say we broke this and we got continuation. For me personally, I would want to see us retest this area and then hold it and continue up higher, right? And I would take the long based off us holding this level and showing signs of going back higher, with a stop loss probably somewhere back within the highs here, not all the way down here, because that would be a massive stop, but somewhere at some point back into the highs within them, that makes sense, where my trade is no longer validated, right? Again, and that's also the power of key levels too, is knowing when your trades are validated and invalidated. We'll touch on that real quick as well, right? Because, stop losses, in my opinion, need to be a market structure. That's just my opinion. I know some people do, they do point values or tick value, whatever, for stop losses. But the problem with that is, again, what's the market's job? is to go seek areas of liquidity, and it's to go run those areas or sweep them or reverse out them, whatever, but it's to go test them. Okay. So the problem with setting stop losses at point value is you may get stopped out because the market is actually going to go test a key area before it goes in your favor. And so you're cutting yourself short by not allowing the market to truly invalidate your trade, but allowing point size or P&L size to invalidate your trade, right? So that's the problem there. And that's why you see a lot of people get, say, stopped out or get wicked out, and then it runs in their favor because the stop loss wasn't at market structure, or it was held at a point value, right? All right, let's move on. Going to the next one here. Again, this is on the NASDAQ. I'm going to keep referring to the NASDAQ as that crazy ex-girlfriend because she likes to be very indecisive and bipolar, right? So we look at liquidity lows, okay? We'll look at lows. This is on a higher time frame too, by the way. This is on a 30-minute time frame you see up here, okay? So this is on a 30-minute time frame. You look at these liquidity lows. Well, we came down and retested them, bounced out of it. At this point over here, now we're trying to decide whether we're going to sweep this and get continuation or we're going to reverse out of it. This is where that bipolar comes out of that ex-girlfriend, right? We say, oh, you know what? We're going to sweep this and we're going to get continuation and come back down the downside. Maybe not, actually. Maybe we're just going to sweep this and come back up within it and catch a reversal out of it, right? And so that's why I refer to the NASDAQ as the crazy ex-girlfriend, because it's very bipolar. You see this happening quite a bit on the NASDAQ, right? And so again, looking at the concepts of this, finding key areas where it's likely to get swept and either get continuation or reverse out of it, right? Here in this scenario, we swept this liquidity, okay? We swept this liquidity, came down, and reversed straight back out of it after sweeping this and came back within, showing bullish momentum, okay? And so that's where you can say, okay, you know what? We swept this. Things are getting pretty bullish now. We're reversing out of this. It seems that sellers have run out of energy on sweeping this. Now you can start looking to the long side because we're getting bullish momentum coming out of this area, right? Now here, up here, it's pretty much, it's the same thing. I just don't have it marked, but you see these key areas of liquidity to the upside. Look what happens. We ran it, bang, straight back down, right? And so finding these areas, again, on higher time frames, whether it be the 15-minute, 30-minute, these hold significant weight. And so again, I'm looking at these levels again, because we are looking high side. I want to reemphasize this, right? We're looking left. When you come to the trading day and you're looking at the charts, we are looking left because we are finding these types of areas, right? And so once we have these levels identified, now that we're coming into the trading day, right? We're coming into the trading day, we know that we can wait for price to come to these specific areas and we can look at a rejection or a continuation coming out of them. Again, all you have to do when you come to trading day is just look left, right? It's that simple. Again, ask yourself those three questions. Where has price been? All right, so we're looking left. We know that price has been up here. We know that price has been up here. We know that price has been down here, okay? And we look at these prices, mark those levels. Where is it trying to go? All right, so coming into the next trading day, we know that we swept this area, okay? We're reversing out of it. Now it looks like we're trying to go back up to the opposing liquidity, opposing side of things, right? Which could be up here. How good of a job is it doing? All right, well, we know that as we swept this, we're seeing bullish momentum carrying us. We're getting back up. Now, granted, this could be, this could be further along there when I screenshot it, but we know that price has been catching bullish momentum after sweeping this and moving back to the upside. Okay, so it's doing a pretty good job at catching bullish momentum coming back up. So it looks like chances are we are to come back up into here. Okay. Again, this is all hypothetical. This is all creating options for us to look at, right? So we're just looking at these types of things and getting an idea and giving ourselves options for what we can look for in the trading day. All right. So again, what are we seeing here? This is another 30-minute time frame, right? Another 30-minute time frame. We're seeing liquidity lows. We're seeing a bunch of lows here where we have multiple touches. Again, referring back to what I said at the beginning of this presentation, is that we're looking for areas of multiple touches where price has been unable to push through or go through, right? That's what we're looking for, is we want to find those areas, okay? Now, this example, we're seeing multiple touches on these lows. We're seeing a 30-minute on 30-minute time frame. We have liquidity lows. We have 1, 2, 3 touches on these lows, actually 4 technically. And then what happens? It's like a pattern that just keeps repeating itself over and over and over again, right? We sweep those lows, price reacts, we reverse out of it, and where do we go? Right back to the opposing area of liquidity, right? You see it right here. We go right back to the opposing area of liquidity. It's funny how that works, right? Where you have very strong areas of liquidity, whether it be lows or highs, and once those get swept, if we are unable to get continuation after running those and we reverse, again, it all falls back on what the market's job is. And what's the market's job? Its job is to go conduct business, find areas where it can seek the most transactions, right? And so look at what we did. We ran those liquidity lows. We swept those lows, swept them, reversed, went right back to the opposing side of liquidity where it's going to conduct even more business, okay? That's the power, guys. That's the power of finding these areas, because at the end of the day, trading can be much simpler than what people make it is. While trading is not easy, I'm not saying trading is easy. Don't misquote me there. Trading is very, very hard, but it's not the technicals that are hard. The hard part is the execution and managing your emotions and your mental capacity when you're trading, right? But trading can be very much simplified by just understanding how price is moving, right? And again, asking yourself those 3 questions: where's the market been? Where's it going? And how good of a job is it doing? That's how really you could simplify this trading, right? Instead of having, now I'm not against indicators. Don't get me wrong here. I'm not against indicators. I have an indicator, right? It's the initial balance indicator. Okay, I have one, so I'm not against them. But instead of adding a bunch of different things to your chart, saying, oh, well, the price is coming down to the 21 EMA, or now it's going up to the SMA, now it's coming back up to VWAP, so I'm wait for rejection on VWAP to come back to the EMA, right? Instead of having all of these roadmaps, just understand what price is doing. Where has it been? Where is it going? How good of a job is it doing? What areas is it likely to go to, right? That's how you get rid of all the noise, right? All the noise from people telling you to look at this or people telling you to look at that. And you just have a clear picture on what price is doing, okay? And where it's going. Now, I will say that the one indicator that I do like and I do favor, and that's VWAP, right? VWAP holds a lot of significant weight in the markets. So I do pay attention to VWAP, but everything else, I ignore, I block out all the noise because, again, I'm looking for those key levels. I want to know where price has had multiple touches, why it's been there, and why are we struggling to run those and reversing out of them, right? How do you determine your profit goal? That's a great question. There's a lot of different answers to that question. It is very much a loaded question. However, you could look at it multiple ways. You could look at it as you're taking an entry to where once you get in profit, you're trimming and allowing the runners to go up to a certain key level. So as an example, right, let's just take this as an example. Block out all of this, right? So ignore this move, okay? Just based off the concepts that we've talked about, we've ran these liquidity levels and we're showing signs of unable to get continuation and consolidating and kind of edging ourselves higher. Let's just say we took a long, okay? Hypothetically, we took a long. I loaded up with, say, 5 micros, for example. Once I got in a profit and I say trimmed 3 of those micros and I have 2 micros left, the next area that I might look for is these lows where we had multiple touches, okay? and I may take all of profit off there. Or if we get to that area, I may trail my stop, right? Trailing each individual 1 minute candle or whatever, however you want to do it. Again, that's a loaded question too. There's a lot of ways to trail. But I might trail my stop and see if we break back above these lows, right? And if we do, just continue trailing and up and up and up and up. I try not to place specific profit targets on my trades, right? Because I'm very much a, trim person. Like I'll get into a position and then I'll trim and then trail. I like to capitalize off whatever the market's going to give me. All right. If it gives me more, it gives me more. If I trail my stop and it stops me out, I'm still in profit. Cool. I won. Right. I have no need to be mad or get tilted. I'm in profit. It stopped me out. I won. I made money. All right. And so I try not to limit myself on the income potential, but rather just focus on letting the market give me what it wants to give me. Hopefully that makes sense. Again, it's just simplifying things, right? It's just really simplifying trading. Because the one thing I have noticed, and I had this conversation with one of the mentorship students that she, would place profit targets, and then you would aim for the whole entire move, and then she'd be up, say 60 points, 50 points on the NASDAQ, which on the NASDAQ that's a lot of money, right? But then it would come back down and come back to break even or whatever it may be. She may trail and it may come down and stop her out, right? The problem with always aiming for 100% of your profit target is your win rate could take a hit on that because of how bipolar and how whippy the NASDAQ can be, because nothing's linear. The NASDAQ doesn't move linear. Yes, no market is a linear move. Okay, there's going to be pullbacks. There's going to be consolidations. There's going to be a lot of different factors that are affecting how price is moving. And so aiming for a profit target, aiming for 100% of that profit target, right, can be, honestly, it can get detrimental to some people's trading and cause them to go on tilt because they got into so much profit, made so much money, and then because they wanted to get all of that profit target, it came back down and stopped them out, right? And so then they go on tilt and start over trading, start trying to get back what they could have made, right? And so that's where things get tricky. So again, just as a simple answer, I try not to limit myself. I trim my positions, I lock in my gains, and then trail and let the market give me what it wants to give me. Now, going back to a previous masterclass that I did over the initial balance, there are intraday levels where there are some key areas of liquidity that the market tends to respect quite a bit. Okay. And that's the initial balance side of things, right? Where it's the first hour of the market open. You have from 8:30 to 9:30. Again, we don't have to go into the weeds on initial balance. I have a previous video on my YouTube channel that goes over initial balance. It was a whole entire masterclass on this that was honestly pretty incredible. I would encourage you guys to go watch it if you have not seen this. But take the initial balance levels, for example. Okay, the first hour of the trading session where we have initial balance high up here and initial balance low down here. This is my indicator that I have with Luxalgo that I partnered on. Okay, up here, oops, went too far. Let me go back. There we go. Up here, we have initial balance high, and look how price reacted. Okay, so initial balance was set right here. Okay, this is where initial balance got completely set. So we know that on the day, IB high, IB low. Look at how price is interacting with that level. Okay, you see it constantly kind of just trying to push, rejecting a little bit. We try to make another push until we just couldn't really do it anymore. And when we failed this area and came right back down to the opposing area of liquidity, which is what? The initial balance low. Okay, so there are levels that you can find intraday like this when the initial balance levels are set. This is a very powerful strategy. I know a lot of people in my community use this strategy and look for trades off the initial balance, right? And so you can mark out these levels. Okay, for me, I'm Central Time, so it's 8:30 to 9:30 a.m. Central Time for me. If you're Eastern, obviously it's later. But Central Time, I know that after 9:30, I can look for price to interact with either the initial balance high or initial balance low. Okay, going to another example. All right, here you can see that again. We have initial balance high where price ran it over and over and over until we just couldn't get continuation. It consolidated a little bit. We broke out, came back below, continued getting above these highs, but back below until eventually we just did not find the strength to continue higher. And where did it take us? Right back to the opposing side of liquidity, right? And this can happen vice versa, where we break out below, right? And see here, we break below, we're unable to continue lower, and we come right back up within it, right? And go right back up, okay? So it all just kind of, it's all about context of the market, right? But these areas you can find intraday. And again, if you have not seen the masterclass on the initial balance, I would refer you to my YouTube channel, or it's on my website actually at tradewithjoey.com. Tradewithjoey.com. That's my website. That masterclass is going to be on there as well for the initial balance. This whole entire presentation is just to give you one idea, right? Out of all these examples, everything that I showed you, all the chart studies, all the chart examples, is to give you guys one thing to think about when you come in the trading day. Well, technically 3 things I think about, which is those questions that I mentioned earlier. Where's the market been? Where's it going? And how good of a job is it doing? But the overall idea is, what levels make sense, right? What makes sense for me to mark as liquidity levels, whether it be previous day lows or highs, or London lows and highs, Asia lows and highs, right? What are these areas that price is likely to go to, and how can I capitalize off price moving to those levels? Right? That's it. That is the general idea of this entire presentation. Again, it is to take a step back from all the noise and simplify things to where you're not feeling lost or feeling like you don't have an idea of where price is going to go or where it's been, or having to rely on indicators or other people, right? You can come to the charts yourself, have total independence, right? Total control over yourself and your trading, and be able to make decisions on your own based off key levels, right? That's where you find success and longevity in the markets, is when you can do these things yourself, okay? I'm a big systems guy. I love systems. I love implementing systems. I love finding where areas where, my strengths are in the markets and my weaknesses are, and I develop systems that fit my trading style and fit me as a trader, where I can capitalize off my strengths, but then contain but get better at my weaknesses, right? That's how you survive in trading, is implementing systems. Think of it as a business, right? What successful business, you look at Tesla, you look at Amazon, Microsoft, right? All these, NVIDIA, all these big tech companies. Do you think they built an empire without having the proper systems in place to help them grow and do that? Absolutely not. Growth comes with systems, right? And that same concept applies with trading. When you can implement systems, you can then build up, your trading and start seeing yourself getting a little bit more profitable, but at the same time, capitalizing on your strengths and containing, but getting better at your weaknesses. With that said, fam, I hope you guys enjoyed this. Again, this was how to really just make things simple and for you guys, and to, be able to gain that independence in your trading, and to, have total clarity, right? That's what this is all about. Have total clarity, gain independence, and, be able to take things into your own hands without having to rely on indicators, without having to rely on other people, copying trades. Come to the charts, marking key levels, and be able to take trades on your own. And so with that said, fam, like I said, I am a big systems guy. If you feel like you need that extra push, or you need that extra and you want to take things to the next level, feel free to DM me. I do have some spots open in the mentorship. Again, here's some proof from people that are in my mentorship. So again, there's no pressure here. You don't have to. But if you feel like you want to go to the next level and you need that extra push, I'm available. All you got to do is send me a DM, and we can talk and go over things like that. But
hope you guys enjoyed the masterclass. If you did, do me a favor, drop a like. Be sure to subscribe to the channel, get more daily content, fam, and I will see you in the next video. Cheers.